Good evening. So this is Saturday, about the 20th or something. Anyway, 21st. Tonight we're going to talk about life insurance. Normally this wouldn't have much of an impact, and I'm not trying to be dramatic here, but with the whole virus and everything else, we'll see what comes of the whole situation when it's all in. But even in a good year, there's a lot of folks who, well, we all are going to pass away at some point. And tonight's topic is life insurance. Now, if you're going to live a normal life, out to 70, 80, life insurance is, not necessarily a thing in your life that you're going to probably take advantage of. Some people may still have life insurance when they're at that age, but that's not really the best way to think about life insurance. And again, I don't mean to, you know, hammer opinions here, but I'll give you some examples of some YouTube folks, well, some examples of some people who are supposed experts and also in the field who, look at life insurance. And the way they look at life insurance is kind of the proper way. Life insurance is when you have some untimely death, when you're say 30 and you might have a kid, you might have, a home, you might have a lot of bills, you might have a non-working spouse, and they are going to have a huge problem if you passed away at that particular age. Now, if you know, get to the aforementioned thing that I was talking about, you live to be about 70 or 80, and because you listened to me or you just had common sense, you put away money, you kind of have a bit of a nest egg, you had a whole bunch of expenses earlier in life, that were like paying for a house, putting your kids through school, raising your children. If you went that way, you had a lot of requirements that no longer exist. You don't need $1 million life insurance when you're older. You can, things run their course on a natural basis, and it's still going to be distressing to your family, but probably not financially, not compared to that situation I talked about before where you have people depending upon you. So the same thing, if you're somebody, let's say another situation, you're 30 and you're single. Well, again, do you need a lot of life insurance? No. I mean, you could get life insurance for cheap because the odds of you dying at that age are quite low. Now they're better, your odds of not dying at that age are even better if you don't smoke and you don't do certain other things. Unfortunately, being a male and other things that, just there's people who work for insurance companies called actuaries who, go through mortality tables, and they can tell you it's information most people don't want to talk about or think about, but they can kind of tell you based upon your lifestyle and odds when an average person in your life is going to die. And if you're in your 30s, it's not you. So they can give you $1 million of life insurance on a term type policy. Just you pay whatever, say $30, $40 a month. You get $1 million worth of coverage. And if you don't die in that period during that term, you get nothing. Fair enough. You didn't die. If you do die, then you get the $1 million. So now there's other life insurance products that we'll talk about that are more like an investment type thing, but you're not getting those for 20 or $40 a month, and you're not getting that same amount of coverage. So again, expect me to kind of show my favoritism, but yeah, I think it's the opinion you'll get from most folks who aren't on commission. There's a lot of money to be made in life insurance because once you get somebody to sign up for a policy, every time they renewed, you get a commission. Term policy, it's not that big a deal. There's not much money in it for anybody in terms of the sales commissions. You can do it online, and so they're probably going to badmouth it a little bit, but we'll go through. It's a decision you got to make, but um, again, we'll talk about it. So, life insurance. As usual, I kind of got ahead of myself. Provides a payment to a beneficiary. The beneficiary is the person, your spouse, your child, whatever, when you die, right? Role of life insurance. So it's not for you, it's for, the people that are going to be left behind, that are going to be impacted financially. And it's, you don't want them to be winning the lottery here. You want them to have money to take care of, the things that you would have taken care of had you been around to be working. Leave money for heirs. You can do that, but you're far better off doing that through investing. Insurance companies, they're even in the best of times, and we're not in the best of times as of a week or two ago, but they're if you want to accumulate wealth, it's not going to be through an insurance policy. And if you try and maintain an insurance policy when you're older, well, a term, they may not even offer it to you. And if you've had the other one, it's been probably not the best investment through the course of your life. So, psychology, easier to focus on happy events. But like I say, in the current situation, people are thinking things. They're shocked when they find out that the normal flu kills what 18,000 a year. But again, when we all get ready to go, something's going to take us out. And when you're kind of teetering on the edge, um, you know, whatever it could be attributed to the flu, even though you probably weren't going to make it 2 weeks, and now you just made it, 2 days. So anyway, there's a lot that goes into that kind of stuff. Um, and then hard to pay for ongoing premiums for the benefit you might not need. Yeah, but this is being responsible. And again, if you've got a spouse or whatever, you're not getting insurance for yourself. You're getting the insurance for the people around you. So, they'll probably think a little bit more of you if you're, you know, the emotional thing, that's not going to change. But the financial bit, that's kind of a self-inflicted wound if you check out with absolutely nothing because it's not that hard to do. Believe me, you can get term life insurance and get it done. Role of life insurance companies. So help clients determine type, but again, this is where the sales stuff comes in. They're usually gonna, not usually, they're typically gonna want to recommend a more complex product that has higher premiums and entails some sort of investment. But like I've kind of alluded to, that I invest money with investment companies, with brokerages and things like that have a potential for growth. Insurance companies are more about stability, and I'm sure they got clobbered in this latest go round with the stock market. It's still going to end up in equities, but it's probably not going to be as managed as efficiently. Applying for life insurance. So yeah, I flew fighters for a while, um, quite a few years. Was in a few wars, a lot of combat missions and stuff. And so one particular event, we're going over to Kosovo, and we just had a guy shot down. So anyway, I was in that situation I was talking about. I had a kid, I had a wife, a new house, and the whole bit. And so I went out and got three separate term life insurance policies, and I had a couple $1 million worth of coverage because they'll ask you all these questions about do you smoke, do you this. They don't say anything like, hey, are you going off to fight a war next week? But anyway, so I got that insurance, and when the insurance companies see you take out a lot of insurance all at once, even the online guys, they have some algorithm or something that kind of keys them in that hey, this guy might know something we don't. So there's a lady, she came out. She was dressed up like a nurse. I don't think she really was, but anyway, she wanted to draw blood and do all this other stuff. And fair enough. I mean, that's the terms of the situation. To get the life insurance policy, you got to do it. But I think they probably, have a way of detecting whether I smoked, because they ask you whether you smoke and all these other things. They want to know your cholesterol, and they want to just size you up and see you in person. And so, yeah, that could happen. Now, what's getting weird now, and it's going to be a bigger deal in your generation, is that the access to, DNA and some of these other things that those insurance companies would love to have to be able to, deny you or insure you based upon what they find in there. So that's why, as a society, we need a little be a little bit more guarded about that because you may be perfectly healthy, but they may, you got whatever screwed up, and they're going to call that a pre-existing condition and not insure you. And life insurance, different than medical insurance, there's not really a means for insuring people that have serious issues. Two types. So term's the one I've been harping on. So it's dead easy to figure out. Specified term does not build cash value, but whatever. That's fine with me. You know, I didn't die. So yeah, I don't get anything back at the end of the term. Paid monthly, quarterly, semi-annually. It's just super easy and super cheap. Again, depending on your age. If you're 65, 70, it's going to be a lot more expensive. But if you're in the prime of your life with all these responsibilities, it's cheap, which is great because then you can get enough to cover everything you need. Um, Determinants, the longer the term, the higher premium. Yeah, they're you're going to be a little older and they're making commitments longer into the future. The older, the higher the premium, definitely. Greater the amount, obviously $1 million is going to cost more than a $50,000 policy. Males, females, because males die earlier and they do stupider stuff. There's not. I'm not being sexist here, but there's not a whole lot of female roofers that fall off of things or do stuff like that. I mean, they're just playing the averages. There's always exceptions, but for the most part, males tend to be in professions that end up getting them killed. Higher premium for smokers and higher for those with medical problems that they know about. And again, there's going to be a questionnaire that you're going to have to fill out and some medical tests, but when they start getting into genetic stuff, that's where it gets serious. So you can see they just skyrocket. They just become unaffordable. When you're 65, the little book says you're going to die here in 10 years or 15 years or something. But when you're down here, till you start hitting about 45, you are good to go. I mean, you can, a lifetime membership is a very good deal. Out here, a lifetime membership is, you might want to pay month to month at the gym. But anyway, how annual premiums? Yep. So it's exactly what you expected, and that's the thing. There is no gotcha. It's very straightforward, and it's very competitive because it's sold. It's you can compare. Pardon me, compare it straight across. When we start talking about some of these other policies, universal life, whole life, variable life, it's like it's very confusing. Term life is term life, male versus female. So again, just stuff we know. Smoke, yep. Decreasing term, so they can do it that way if they wanted to, where maybe it starts out as it's all marketing. It can be a $1 million policy for $20 when you're 20 years old, and then it's only a half a million when you're 45. Or, they can increase the premium. It's a $20 policy for $1 million coverage when you're 20, and it's 45 bucks a month when you're in your 40s or something like that. Anyway, you just have to look at the details. Mortgage life insurance. This is they're just kind of throwing this in here. What this means is a lot of times you'll see if you get to the position, which I hopefully y'all will soon, where you're going to be buying a home and the mortgage company will come out with some document with this great deal for you, but likely it'll be a condition of the loan and it will pay off the mortgage, your home mortgage that's associated with this policy um, in the event of your death. So they want to do that because they don't want to be fighting with a grieving spouse, at a funeral over the payment being done. But also, you need to kind of keep track of this because I'm throwing around this term $1 million policy, just because it's a nice round number. But what you need to do is you need to do some math and look at your situation and say, okay, in the event I die, I would like to, depends, and there's so many individual factors. Is my spouse working or not? You know, did do we have a home? What's my spouse's education like? Um, in my case, would she need to get some training, perhaps go back to school? These are all things that you can kind of calculate in. I've got 2 kids, let's say, so I want, 100,000 per kid for college. I want, say, 300 grand to pay off the house. I want this much. Okay, $1 million will do. And you come up with that number. And like I say, as you go through life, that number is going to decrease to the certain point where hopefully your nest egg is built and you go, wait a minute, I got, close to $1 million in stocks or savings or something. And you say, I don't need that insurance anymore. I'd be better off getting that, by then term would be, I don't know, $100 a month. So I'm better off putting that into other investments directly. And now the, you know, my beneficiaries upon my demise, upon my death, they're going to inherit those investments. So they're not going to get an insurance payment, but they're going to get that even better. They're going to get the cash directly from their own investments that are, will be transferred to them in the will. So anyway, we'll talk about wills at a later time. But anyway, mortgage life insurance. The point that I'm bringing up here is if you have mortgage life insurance, that 300,000 I said that you needed to calculate to pay off your mortgage, well, that's already going to be taken care of if you have mortgage life insurance, which is quite normal. Group life, group term insurance. So, yep, many times you can buy it through your employer. Um, and again, just like medical insurance, it's cheaper when you do it through a group. Insurance companies, they like to spread their risk. They work off averages. So the more people in that pool, the less ripples are caused by an individual, member, you know, passing away. If they've got 1 million people under some group, then it's the averages and all the statistics work out very smoothly. If it's you just taking insurance yourself, it's harder for them, and they reflect that in higher rates. Okay, so now we're getting into some of this other stuff. So for me, I'm good with term, and that's all I've ever had. And now we're talking about other things that are going to be a little different. So, okay, so whole life insurance, and all these names are just kind of, nebulous out there. Whole life, permanent insurance. Um, so the way these things work and the way they do work is they take a much bigger chunk. Let's say, I don't know, 400, 500, 600 bucks a month, and then provides benefits to you, and then also has a cash value. So even if you don't die, there's still, a cash value, which is the investment part that I'm talking about. Now, if these guys specialized in investments and they got good yields, that might be one thing. But just like I'm telling you, when you're buying stocks, when you're, doing other investments, you try to stay away from commissions. Well, that's not happening here. Whole life and all these things. You can't just go online and buy one of these policies. No, it's got to be presented to you by a licensed person and yada yada. And there's a whole infrastructure and you know a substantial chunk of your investment money is actually going to end up as commissions. Um, so yeah, it's still the payout. The age, your health, male, female, all that stuff still going to be reflected in the amount of money you get. But and then different ways of doing it, limited payment policy. So, you can pay say $600 a month for say 20 years, and then you're considered paid up, and your insurance remains in force. Fair enough. Um, I've had people try to sell this stuff to me, and I felt bad for this lady because I mean, she was telling me how it was going to be money ahead, but I looked at the, the chart. I'm like, wait a minute, I'd be 95 at that point. I mean, I wouldn't even know if I had insurance. And anyway, it's a tough gig for those folks. But anyway, they do well. They do sell it to a lot. And if you've got it already, I mean, don't just do your research. And again, don't go off, one professor telling you one thing. Do your own due diligence, but the prevailing opinion out there definitely, goes to term. Whole life has higher premiums. Whole life accumulates savings, and premiums remain constant, but they're not going to be cheap. Universal life, same thing, but accumulates. So you can see how these things kind of blend together, and you're like, wait a minute, whole life, universal life, variable life. I'm not going to go into details on this on the exam, so don't worry about trying to parse out these ones because, again, these are not necessarily whatever. Term is term, that's a constant, but a State Farm variable life versus a New York Life variable life, they're going to have different characteristics. And anyway, um, what they have done though is they've changed some of the policies to try to make them more competitive, in terms of investments and or different people's situations. Variable this time, over specified terms, and then invest residual funds after the term portion is paid. You know, the, again, it, it just gets too complex. Determining the amount of life insurance. So this is what I was kind of talking about before. Now there's different means of doing this, and this is, when you say how much insurance you need, um, they have these different formulas, and a couple of them are just semi-stupid. I mean, they're in the book here, so I'll just put it out there. But 10 times your annual income. That says nothing to your situation. If you're single and you don't have a home, well, if you're single, you don't even need it. Number one, unless you've got somehow somebody dependent upon you. But anyway, so 10 times your annual income doesn't make a whole lot of sense, especially when it's affordable. Um, that's anyway. Easy, but doesn't consider individual circumstances, so basically worthless. Budget method. So based upon expected future expenses, so living expenses, special future expenses, kids, stuff like that. If you have some debt out there, marketability of the spouse, perhaps, I don't know, a couple year buffer in there for your spouse to re-enter the work environment if they aren't there. The age of your kids, if you got kids that are not school age yet, that's going to be delayed. So there's a lot of moving parts that this, type of formula uh, helps to capture. And then the internet, that's a little broad in the way of, I mean, you can use the internet to figure out anything. The only ones of value on the internet would be something like this that take into account all these other factors. I mean, the internet may have, you can go to some of these life insurance websites, but again, they're probably going to steer you to some of their commission products. They don't make a whole lot of money off of term. Um, So, major illness or disability, yep. Family income may not rise. We're all along for the ride on that one. Inflation could cause you, well, yeah, but we're not stupid, so we will, think about inflation that, you know, maybe $100,000 for a kid's college is not enough. But if my kids say we're 5 years old and 100,000 now, time value of money, inflation is not going to have a huge impact in that because I'm going to invest it and that's going to keep up with inflation. So debt level could increase. Anyway, they're the budget method is gonna work for you if you keep track of all your expenses and try to again have those who are dependent on you unaffected. Whoops. Um, Life happens. You can get all kinds of different apps out there. Um, so any insurance company or retirement planner, there's plenty of insurance people because there's going to be banner ads. You are somebody in the market for insurance. So believe me, there's going to be some nonprofits and other people that are going to put that information out there, and the you know marketing people in the periphery are going to be ready to pounce. Because again, if you can line up somebody with insurance and have them pay for the rest of their life, that is amazing in terms of commission, what that can do for them. Um, Needs and dreams. Yeah, and I don't. This discussion, education for, it's what you want is things to continue, and if you have an untimely death, um, like I say, you don't want people thinking ill of you that you weren't responsible. You'd rather have your funeral concentrating on how much they're going to miss you, not how they're going to survive because you failed to just go online and get a policy and make sure you were taken care of. It's again, it's just one of those things you got to do. And it's one of those things too, even in these tough, times that we're about to be in, if you went all in on one of these variable lives or something like that, one of those whole lives and had $600 premiums, you might not be able to keep up with that. But regardless of what happens, you probably, hopefully, will be able to, cover that $40 premium for your term life or and they're not going to cancel you day one. I think some things are going to kick in here to give some forgiveness, but you may actually end up having to pay all those premiums, when things get back to normal, but it's not going to be such a big chunk if you went with a more conservative type of thing. So beneficiary, I've spoke to that. That's the person. So, you don't have to again, if you've got children, you don't have to name all your children in there. If your spouse is responsible and the person you trust, then you name her or him or whatever and expect them to take care of it for you. Grace period. Things with insurance. I was actually at a point where I canceled out on some of these term life insurance things. And yeah, they just start sending you letters saying, if you don't make a payment, we're going to cancel it. And it went on for about 90 days. And finally I called them up and I said, yeah, I definitely cancel it. I called and I said, I want to cancel it. And they said, yeah, we still need to send you all of this mail for, a period of like 3 months just to cover ourselves. So, you know, anyway, so there's a period. And the grace period can also be interpreted different ways, but typically the grace period I'm looking at is for missed payments. Living benefits. This is kind of a nice policy. Let's say you're in debt due to your medical situation, and it's finally determined that you're terminal. You're not going to make it. You're going to be gone in a couple months, and you've got some $1 million policy out there that they're going to get access to once you pass away. Well, in certain conditions, you know, with coordination of the policy and the authorization that are indeed not going to make it, some of that money can be freed up while you're still alive to take care of some of the issues and you know make it a little bit more pleasant. Non-forfeiture clause. So that's a whole life type thing where there's money, there's a cash basis in it. Where there is a cash basis too, sometimes you can take loans against it. Incontestability clause, kind of legalese kind of stuff here. You're going to sign certain things saying, yeah, I don't smoke, I don't have high blood pressure, and then, you know, believe me, if you die a month after you get that policy, you're going to go, wait a minute, it appears you were smoking, and it appears, you did have high blood pressure. But there's going to be a period in there, say after a year or so, even if you fibbed a bit on the initial form where they still got to take you. It can't be contested. They're still going to pay it off. Renewability. Um, Sometimes on the term life insurance policy, you have the option um, to renew it, or sometimes you just go out and shop for another policy. But it's probably cheaper to stay with the one you actually have because you're a known quantity to them. They've been insuring you for 10 years and you haven't died. They're no one, you're not somebody like me who's going to go do something semi-dangerous and all of a sudden is trying to ramp up their insurance before they, you know, do that event. Conversion option. This gets into whole life again. Um, so you're converting your term into whole life if you wanted to do that. Uh, Settlement options. So lump sum or payments over time, different ways. It'll probably be more money if it's paid over time, or it's like a lottery winning type thing where you have different options. Oh, there we go. Lump sum and installments. Interest payments. Yep. If you didn't need to draw from it. Selecting a life insurance company. So you're going to find, as you go through personal finance kind of stuff, there's certain companies that do certain things. Morningstar is kind of the company that you look for when you're um, trying to determine um, mutual funds. Uh, Moody's does certain things. They do bond ratings. AM Best, this company, they do insurance companies. So again, these are third parties, so they're not, owned by the insurance company, and all they do is ratings. And so that's what you want. Typically with an insurance company, life insurance, or well, really any kind of insurance, but specifically life insurance, it should be a company you've heard of. I think mine were through GE and Mutual somebody, at least some companies that I thought I had heard of at one point, but then you'd verify it in AM Best because what you're relying on is the, financial, um, you know, solvency of this company to pay the policy. So they should be one of the top rated companies in whichever one you pick. So if you see something that looks too low, then that's a problem. Um, so you're going to see a thing, the video this week. It'll probably be Sue Zorman, who's some people like her. I mean, she's very popular. She does investment advice, but she'll kind of go down that whole term life insurance thing that I was talking about in terms of the comparison between term life and whole life and how most people are talked into these more complex products when term life is probably something you need. So right now we're going to jump into investment fundamentals. So I'm just going to blow through some of this stuff because we're really going to spend a lot more time on this in the upcoming weeks. But we've talked through some of the more mundane stuff, the insurance and the healthcare kind of stuff, and now we're into stuff that will, help you amass wealth, And believe me, if you had cash right now and could invest it, you'd do very well. A year from now, I'm quite confident that the market's going to be up, further than it was before the start of this whole thing. But again, we're kind of in uncharted territory there. Um, Types of investments. So they're talking about looking at your balance sheet, kind of seeing where you are. If you think you're going to, have credit cards out there that you still owe money on and make more money in investing, no. Your first thing for investing is to get rid of that high interest debt. Even if say you could make 10, 15% in the market, um, it's going to be taxable. Whereas if you're paying double that on a credit card, um, you know, you can't write it off, and it's just going to be a huge debt. So you gotta take care of that. Pay the liabilities off. Ensure adequate liquidity, certainly, but again, try to invest in things that offer liquidity. You don't have to necessarily give that up. So money market securities are kind of a holding place, kind of a parking place, and this is where when you set up a brokerage fund, these are going to be backed by the U.S. government, and so even in times like this, they're a dollar in that account is still worth a dollar. They don't make much in the way of interest, but they're secure. Stocks stocks are a chunk of a company. A company, they have two ways to raise capital, a big corporation. One is to issue bonds, which is basically a loan. And, you buy one of those bonds and you loan the company a certain money, but you have no ownership position. With stock, you actually own a part of that company. That's why you'll hear them called equities, because you have a position, you own some equity in that company. Now, this deal between common stock and preferred stock, I'll just mention it here just to tell you that don't worry about it. It's not a big deal. It's, obviously preferred stock sounds, oh, that's what I want. I don't know that I've ever had any preferred stock. It's just not that common. Because number one, most people who are in growth type companies are in companies that are not income um, related stocks where they're paying a dividend. Most small companies are still growing. They're growth companies, and they use what would be dividends. They don't give them away as dividends. They get their profits and they expand and they try and build the company. So what happens here is if a company is paying dividends, and typically if they're a good company and they're paying dividends, they're going to pay them to both. But if this company's starting to fail, which I want to dump that stock anyway, if they're not going to be able to pay a dividend, then they got to pay it to the preferred stockholders first. But anyway, that's not a situation I want to be involved in. I don't have any interest in companies that pay dividends. Number one, because I'm more interested in growth, and number two, if it comes down to that company, starting to get into trouble where they're unable to pay a dividend, I'm not sure that you know it's the difference between getting preferred stock, getting that dividend that one last time. I'd want to get out of that company before something worse happens. Okay, primary and secondary markets. So if you say you want to buy some Ford stock, you're essentially buying somebody else's Ford stock, right? The stock, it doesn't, it's not like a car or something. Well, in this case, Ford's probably a bad example, but there's stock out there in the market. So if you buy Ford stock, you're buying generally some Ford stock that's already out there in the market. You're buying somebody else's stock. And so that's just kind of how the market works. Now, Ford could be issuing new stock, and you could perhaps buy that, but that's really the exception. A lot of times, they might have a program like that, but a lot of times it'll go through a commercial bank, and you'll only be able to buy it on the secondary market. I buy some stock directly from a company I work for because they give me a 5% discount on it, and I sell it the next day, which they don't like, but whatever. But the only reason I do that is because I get the discount on it, and in that case, it's not actually going through a stock exchange; it's coming directly from the company. But that's just a employee stock purchase program. Um, Also, you'll see IPOs, initial public offerings. So this is when a company says getting started, they've got to a certain size and they decide they're going to go public, right? They decide they're going to issue stock to the public. Well, as much as we all think we'd love to jump in and get involved in some IPO, this isn't really a level or fair playing field. IPO stocks, typically, unless you're some special investor, you're not going to have access to it till it gets to the secondary market. So, when Facebook went public and when some of these other companies went public, I had friends who tried to get in on the initial public offering, and they didn't get the stock at the initial price. I think it was came out for $24 or something, and they bought it somewhere around 40. But the first day is always super chaotic because they come up with a price that they think the market, is going to accept, and it's kind of a no telling thing. Sometimes the initial public offering will come out, say at $24, and all of a sudden the price just drops. It's really hard to gauge that. But anyway, that's in the big, commercial banking sector who handles those big transactions. But the secondary market, that's where existing stocks are traded. So again, you go online to, Ameritrade or Fidelity or, T. Roy Price, or pick your brokerage, and you want to buy some stock off, say, New York Stock Exchange or something. You're buying out there in the secondary market. Types of investors. So there's really three types. This whole day trader thing is just kind of an anomaly that they've thrown in there. But institutional investors, the big boys, these are very closely related to portfolio managers as well. But portfolio managers might be associated with, say, big mutual fund companies. They're managing a big portfolio. Institutional investors, let's say you're, a teacher, or let's say you're the Alaska Permanent Dividend Fund. Um, those guys, um, I'm not sure with the dividend fund whether it'd be considered portfolio or institutional, but you'll see, the Michigan teachers or the, Chicago public employees or whatever union, those are big boys, and they're trading huge sums of money. And then you get down to this bottom one, the individual investors, and that's, you know, what you and I might be doing with our excess money, where we're buying individual stocks or whatever. Um, our retirement plan, if we did have one, would be handled up here. If we had mutual funds through our company, they'd probably be handled by a portfolio manager. So individual investors are very, very, small proportion. Now, in certain times, and usually when the market's doing quite well, you'll get a bunch of people get involved and they do day trading, which is it's just kind of a goofy thing. I'm not going to spend much time on it because it's really not investing; it's speculation. Um, they buy, and they're talking fractions of a cent, and they jump in and out of trades, and sometimes they convince themselves that they're really good at this, but other times they just get cleaned out. It's not as popular. Back in the, I'd say, mid 80s, it was real big where they'd have these places set up where people would actually go in there with, and computers were just kind of coming online then. You don't hear so much about it now. They still exist, but not so much. I would just go with these top three. So I mentioned a little bit about bonds. Let's say a company wants to get bigger. They need money to fund something, or it could be a government, where they want to issue a bond for education, to build new schools, or perhaps build a stadium or something. Obviously, governmental agencies, they can't sell stock, so that's their only option. Corporations can sell bonds, or they can sell stock. And the way this works is, let's say, they need some money, and they're basically borrowing money from you. So the terms of the deal are, let's say you give them 20,000 bucks, and in consideration of that, in return for that, they give you say 3%. Um, so 3% of that money back uh, every year. And then, since it's a 20-year bond, at the end of that time period, they give you all of your initial investment back. So you gave them 20 grand, they give you your whole 20 grand back. Now, granted, the 20 grand is not quite worth what it was in terms of buying power when you gave it to them, but you get it all back. And that's unless they default. But bonds are kind of a sucker's investment right now because interest rates are so low that the value of bonds, and I'll have to spend a little more time on this, but the value of bonds is affected by interest rates. Because I said in this case you have a bond that's going to be yielding 3%. Well, if interest rates go up, new bonds will be issued at say 4% or 5%. Well, if you try to sell your bond in the secondary market and it's a stinky 3% bond, nobody wants to buy it. So, bonds you can sell in the secondary market just like you can sell stocks. But if you try to sell it, people only want to give you, say, 18 grand for your $20,000 bond. Now you can be stubborn about it. You can keep it till the whole 20 years and get your whole 20 grand back. But that whole time you're going to be stuck with your, you know, below average 3% yield. So if interest rates right now were say higher, maybe 8%, 6, 7%, you might want to have bonds because if the interest rates go down, now your bond would be more valuable, and so you could sell in the secondary market for say 22,000 or something like that. But when interest rates are almost at zero, um, they've got nowhere to go, but they can't go any lower. So the upside is nil, and the downside, that is, if interest rates normalize and go up to a higher rate, you're in a bit of trouble. So anyway, but that's how bonds work. They're a loan, and they don't represent an equity position, and they are an investment. So, and people will always say this. So, well, I want to have some bonds, I want to have some stocks, I want to have, they say I want to be diversified. Well, diversifying into something that's not good is not, there's not a lot of logic to that. In a normal market, there would be, to spread your risk around. But um, right now, if I had any, I don't have any bonds. Mutual funds. Okay, mutual funds are a good thing. They are something that you probably will have, probably should have, before you go down this rabbit hole that I'm talking about with buying individual stocks. Mutual funds are probably where you want to be. Mutual funds are something you may already have too through your IRA or your 401k, or if you're military, your TSP, thrift savings program. They are they're still stocks typically. They can't have other things in them, but typically they're stock, equity type things. And so rather than say, you going out and buying Apple, you might buy a mutual fund that has technology in it. And so it might have, you know, Apple and Microsoft and whatever else, Nvidia and a whole bunch of different technology firms. And technology firms, you could rightly make the estimation that, oh yeah, technology is always going to be going up, and or like let's say right now, there's companies out there that do some of these remote doctor type things, teledoc or whatever type things. You may say that industry is going to take off. This is a no-brainer. I got some money, I'm going to invest in this right now. But trying to pick that individual company that's going to be the one to become the industry leader, that might be tough. But if you bought a mutual fund in the medical sector that specialized in remote services, that would be a far easier pick, and it might be far more profitable, certainly less risky. So that's why mutual funds are attractive. Mutual funds also have a portfolio manager, a guy or gal, whatever, or a team that takes care of making some of these buy sell decisions. And some of these guys are like high paid coaches, and they are, some of them are quite high paid if they have a track record of making smart decisions. So again, it gives you a chance to sort of put these things on a little bit of an autopilot where you're not having to, do a bunch of research. You do some initial research through companies like I talked about Morningstar, or maybe even some research or common sense to go, hey, I think this is an emerging field, and then pick that mutual fund and look at their track record through Morningstar and some other things, and then invest in it. So mutual funds are a good thing. Um, yeah, they also have some of these things where a lot of mutual funds are quite popular, and some people, we'll talk about index funds and so many different types of mutual funds. We'll spend more time on that, but there's some that um, have, yeah, they're tied to um, stock markets where they can actually be traded on exchanges. Typically, mutual funds, you just buy those through the company and you don't do this whole brokerage thing. You just buy them. It's a different process, but we'll go into that in detail. And then real estate in terms of investments. I'm feeling quite happy, with having a fair amount in real estate because you can enjoy it, and especially at a time like this. I know, you know, mutual funds and stocks, they don't do a thing for you. You look at the statements and stuff, but if you have some real estate, not only can it prove to be a good investment and a good diversification, but also, it gives you some immediate enjoyment in terms of being able to enjoy it. Now we're also talking income property, rental property, and other things too. But your own home is definitely an investment in real estate. Investment return. Yeah, so this is I alluded to before. If you're buying a stock, let's say, you're buying a growth stock, it's traded for $20, you're expecting it to go to 35, or you're hoping, and that's where you're going to make the money. You're going to keep it, you're going to sell it for $15 more than you paid for it, and that's how you did it. Or you get this stock that's out there, say it's trading for, 80 or $90 a share, and it's very sluggish. It doesn't do a whole lot, but it pays a good dividend. It pays a couple 3%, which is better than the banks are paying, and you're happy with that. And that's an income stock, and you don't expect it to jump in price very much. It's a big company. It's General Electric or something like that, and it's had its big growth spurt many decades ago, but it's still viable and it's still paying money. And that's, how you're making money. So the growth stock was the price appreciation one. The income stock was the one that's going to be paying dividends, right? So, and they also say that, they say that when you're younger, you should be in growth stocks because growth stocks are going to be more volatile. You can have situations like we're in right now. But if you're, a retired person and you're living off your stock income, well, you're not going to be eating here for the next few months. Whereas if you had dividend stocks, you're going to still have a smaller but a steadier income. So people tend to prefer those as they get older. How do you get money? So return on investment bonds, it's that interest rate, right? Or the bond price appreciation, which I'm telling you is not going to happen right now because the bonds are interest rates are only going to go up, which is going to make your bond depreciate, not appreciate. Returns from mutual funds, same as stocks, right? You can make money on the capital gains. The shares sold for $20 and now they sell for 35, or they may also have some stocks in there that are paying a dividend. So mutual funds are just a collection of stocks, and so they're going to respond the same way stocks do. And then return from real estate could be rental income or price appreciation. Or also, the fact that you're not having to pay rent for your own place. You know, we're not going to do formulas. because this it seems very complex, but it's not. Return, how much you paid for it, what you sold it for. There, it'd be far easier to express it that way. If there was a dividend in there as well, so let's say, you bought it for 20, you sold it for 30, you made $10 on capital gains, and plus you're getting a 3% dividend in there, so that D, so you got 3% of whatever your account was for that entire period. So it's basically going to be that capital gain plus the dividend. Again, they're trying to make it look more complex than it is. Typically, though, with most stocks that pay dividends, they don't have much in the way of growth. And the ones that have explosive growth, they don't have much in the way of dividends. This would be, growth stock would have these numbers would be relevant, and an income stock, the dividend would be relevant. Tax returns. So remember when I said long term versus short term? And this is why. So, yep, taxed as ordinary income. So you're going to be taxed on whatever money you make. Now, if you have stocks or mutual funds and you keep them for longer than a year, then that's considered a long-term gain. Less than a year is a short-term gain. So typically, long-term gains are taxed at an investment rate of about 15%, whereas short-term gains, they're just thrown into your income. So if you're, say, in a 28% tax bracket, you're paying, almost double the tax on that. So it's just something to think about. If you see a stock jump up in price, you need to, make a calculation here to think, is it going to stay up there, or is this a spike that may drop back down? If you anticipate it may drop back down, you might want to sell it. But if you expect it to stay up there, you'll probably want to keep it for at least a year, so the tax rate will be roughly half. So they're showing the 15, they're showing 35 for this guy. Could be, whatever. It depends on your situation. This is when we started getting into tax brackets, back on that discussion. That's fairly high for right now. But it makes a huge difference on what you get to keep. Investments risks. So when we talk about risk, risk is definitely related to, should be correlated to the return. What you don't want is high risk with low return. If you expect to make 15-20% on your money, then you are going to be enduring some risk. If you don't want to expose yourself to any risk at all, then don't expect to make any interest, and that's just kind of how it works. In bond ratings, they actually rate them, and again, Moody's Moody's would do the bond rating. Anyway, and there's a couple different agencies that do it, but just keep in mind there's a bit of grade inflation. If you're looking at a bond that's, say, down in the C range, well, D is definitely in the junk range. A company that is about to fail, their bond rating is going to go way down, and D, like as in default, meaning they're not paying you back. You loaned them money, and they're going under, and you're getting nothing. So you definitely want to pay attention to that. And, high risk bonds will be marketed as, high yield, but they'll also be referred to as junk bonds. Now, you'll never see anybody, selling junk bonds, titling that. They'll call them high yield, but they're the same. So, uh, AAA, double A, those kind of letters are what you're looking for, not into, a single A or even a B or something like that. Now we're starting to get into sketchier bonds. Small firms have more growth potential but higher risk. IPOs, a lot more risk. IPOs are pretty speculative because you really don't know which direction it's going to go. But if it's a company you really believe in, you know, it could be something. And there's a lot of companies too that you think you might want to invest in, but you might find out that they have never done an IPO. They're still privately held. If you do anything with drones or whatever, there's DJI that I think is still kind of the dominant company in there. Anyway, they're privately held, so you can't buy stock in them. So you have to kind of, do your homework. Um, Bonds, yeah, it's just same thing. If you're making a loan to a small company or a large company, it's going to be lower risk, low return. High risk, higher return. Mutual funds, it's all governed by the underlying stocks. Now, one thing with mutual funds you got to be careful of, and I did this myself, where I thought I had some diversity because I had, you know, different mutual funds with different companies, and they were all kind of in the growth category. And when you buy a mutual fund, you'll look at a thing called a prospectus. Typically, it used to be on paper, but now they're online. But anyway, you have to acknowledge that you've read the prospectus before you can buy any mutual funds. And part of that prospectus, um, and also the documentation that comes along with that investment, you'll be able to see what their current companies that they hold, current stocks they hold. And in my case, I had a ton of Apple. I wasn't diversified at all. I had these different mutual funds, but they all were predominantly, made up of Apple, which wasn't a bad thing, but it wasn't diversification. That's for sure. Real estate is we'll spend a whole week on that, but yeah, renters could default, property value could decline. Not nearly as risky as stocks typically. Borrowing to invest. Borrowing to invest in real estate is quite typical. That's the way it's done. Borrowing to invest in stock market, that's called leveraging. That's not smart. Buying on margin, not not a prudent thing to do when well, it's definitely into speculation. It's not into investing and taking risks to recover losses. If you've ever gambled, you've seen people, double up to catch up, and it usually doesn't end well. And then the term project. I'm gonna have to spend some more time on the term project with you, but keep in mind we're kind of getting to the point. You may have some time in your hands, may not. Everybody's different in the situation, but the term project is going to be coming along. Um, the big picture here of the term project is that you can customize it, you know, to your own situation. So I've had people have some crazy plans out there. I mean, crazy in a good way, in terms of variety, what people are going to do. And um, if it's, as long as it's useful to you, that's going to give you some way forward, it will be a valid submission. And that's it. I'll post the rest of the stuff probably tomorrow.